So let me give you a very simple example, very rough back of the envelope that I first came across when I started thinking about some of the business aspects of biotech. The cost of developing a single anti-cancer compound is, roughly speaking, about $200 million to do those clinical trials all the way from phase 1 to phase 3 and new drug application. About $200 million, give or take. That's just for one therapy. The probability of success in oncology historically has been a little bit less than 5%. That's the success probability. So in other words, the failure rate is something on the order of 96, 97%. So how many of you would want to invest in this kind of an investment? It's just not practical. It's not something that investors are going to want to do. Now, I haven't told you what the rewards are, and for most investors, they don't even need to hear that. Once you tell them 95% failure rate and $200 million upfront, 10-year investment period to do the clinical trials, they're just not interested. In cancer, if you get an approved drug, you're talking about something like a $12.3 billion asset. So in other words, after you take 10 years to do the clinical trials, and if you're lucky enough to get a drug approved, you're going to get an asset that will pay out $2 billion a year in profits from years 11 to 20, which when you calculate the present value is worth about $12.3 billion. And that's one of the reasons why investors might be interested in this, is because you're talking about a really big payday if you're successful. But when you look at the numbers, in fact, an expected return of 12% and a standard deviation of 423.5% gives you a Sharpe ratio of basically 0. So we're back to the case where nobody is going to want to do this unless there are some other circumstances involved. So one of the problems of making an investment is that you're talking about too long a time frame. And this clinical process of taking 10 years to go from phase 1 to phase 3 to new drug application, very, very few investors have the financial stamina to last that long and to keep that much capital at risk without any kind of payoff. And so what happens is that in the industry, we take that 10-year process and we chop it up into smaller, bite-sized investments. And that's where venture capital comes in. So what is venture capital? Venture capital is the part of the food chain where investors are trying to help take this idea from the laboratory into the clinic and ultimately into approval, but it's a very specific part. And so let me describe to you what that part is. So this is a very loose graph of how a startup happens. We begin with an idea, a concept. And in order to take that concept and make it real, you've got to spend money. And so this curve right here is your cash flow. For the first few years, you're just burning up cash, negative cash flow. You're spending money until such time as you basically start generating profitable activities. So this period can be a very, very long process. For most technology companies, it's actually pretty short. So maybe in the case of Amazon, when you're doing something really big, that takes many, many years before you get cash flow positive or profitable. But if you're doing an app, first of all, the amount of cash that you're spending is not nearly as large as for a biotech company. And second of all, things move so quickly that within a matter of, 18 to 24 months, you pretty much know whether you've got a winner. And if you have a winner, then within another year or two, you're actually generating cash. And probably within 3 or 4 years, you're profitable if you're going to succeed at all. That's not true in biotech. In many biotech companies, you're not even hitting your first milestone in 3 or 4 years. So it's a very different proposition. But in any case, where the VCs come in is not here. They don't like this part because at this point, it's really hard to assess what the returns are. So where the venture capitalists come in is when you need a big slug of cash to get you over the hurdle to positive cash flows. So this is what's called the early stage VC, late stage VC, and by this point you can think about doing an IPO and investors can exit. They can take their money that they put in at the early stages and cash out by selling their shares on the open market. So the idea behind VC is that they're getting you from here to here. What do you do about this part? I'll get to that because that to me is the most important part for this audience. Not this part, but rather this part. But I'll get to that. I want to make sure we cover all of our bases. So the idea behind a venture capital firm is that it is designed to basically take those ideas that are already fairly clearly far along in terms of having business potential and taking it to the point where it now becomes a real live sustainable business entity that's generating profits at some point in the not too distant future. So a venture capital firm is comprised of different components. You've got general partners. These are the individuals who are selecting the projects, working with the entrepreneurs, and developing the companies. They're the ones that are managing the portfolio of assets that the fund is meant to invest in. Those are the general partners. The limited partners are individuals that know, in many cases, know very little about biotech, but they trust that the general partners have expertise, and they will put money into the venture. So they are bringing money to the table. There was a facetious definition a while ago that I was first introduced to about what venture capital is. And the facetious definition is that a venture capital fund is a partnership with a finite life, meaning it has a beginning and it has an end. Typically, a fund lasts for 6, 7, 10 years. That's the range. And it has a finite life, which has a beginning and an end. At the beginning, the partnership starts when the general partner brings his or her experience, and the limited partners bring their money. And it ends when the general partners leave with the money and the limited partners leave with the experience. So that's not too far from the truth in a number of cases, particularly venture capital funds that have not done well. But it also highlights the differences in the roles of the two different groups. General partners are responsible for the fund. Limited partners, they have very limited roles in managing the fund. They're providing the capital. And the limited nature is not just in terms of what their responsibilities are. There's a legal definition. Limited partners cannot be sued for anything that happens in terms of the firm or the fund. The general partners, they can be sued if it turns out that they ultimately invest improperly or involve certain kinds of financial misdeeds. So once you set up a fund, the idea is that general partners invest in various different companies. These companies are owned by the funds. And as those companies do well or not, it flows through to the limited partners. The limited partners experience the financial ups and downs of those investments. And so the typical life cycle of a venture capital fund is it begins when the general partners go out and raise money from the limited partners. So they raise a pool of capital, $100, $200, $300 million. And that pool of capital is set aside to be invested over a number of years. Actually, no money changes hands on day one. The capital is called by the general partners when they need it. So when they invest in a new company, they need to put $10 million to work. They'll ask all the limited partners, OK, time to give us $10 million of the $200 million that you've committed. And over the course of 5 or 7 years, they will invest in a number of different companies. And as those investments mature, the limited partners will eventually get paid back for all of the investments that they made. So that's how it generally works. Now, it turns out that venture capital is high risk. And it's high risk, not surprisingly, because the general partners don't know as much about what's going on with your firm than you do. So this asymmetry of both information as well as control means that, number one, people who invest in VC funds, they need to be willing to take losses, large losses. In fact, if you put your money in a venture capital fund, you need to be prepared to lose all of it. And if you can't afford to lose all of it, you shouldn't be investing in these funds because they can be very risky. With that said, the idea behind the venture capital fund is to spread out among multiple shots on goal, multiple investments, so that the hope is that even though a number of them will fail, the 2 or 3 successes that you might have will be more than enough to pay for all of the other failures. That's the general idea. But in order to mitigate the possibility of failure, venture capitalists will put all sorts of protections in to make sure that they can deal with these asymmetries of objectives, information, control, and so on. And all of these protections are highlighted in the term sheet. So when you start working with a venture capitalist, the first thing that will happen after you give them your pitch and after they ask a whole bunch of really invasive questions, the first thing that'll happen is they'll say, we're interested, and we'll start putting together a term sheet. And the term sheet basically outlines the terms under which they're going to invest with you and under which you're going to use the money to be able to generate returns for the venture capital fund.